What if the market everyone trusts most is the one that is most dangerously late? What if Wall Street is celebrating a future that oil is already warning may never arrive? And what if the next economic shock of 2026 is not being announced by stocks at all, but by the one market that still lives in the physical world? Hello everyone, I am John A.G. Welcome back to my channel, The Wealth Reactor. If you value serious, premium, and intellectually powerful analysis on oil, inflation, financial markets, the global money system, and the economic crises shaping 2026, then do subscribe to my channel and also join my WhatsApp group for real updates. Because on this channel, we do not chase noise. We break down the deeper forces moving the world. And today we are looking at a topic that serious viewers should not ignore: what oil sees that Wall Street is missing. There are moments in history when financial markets look confident, headlines sound optimistic, and investors begin to believe that the worst is behind them. Stocks move higher, commentators talk about resilience, and the mood shifts from fear to relief. But beneath that optimism, another market sometimes tells a very different story: oil. Not because oil is emotional, not because oil is speculative in the same way, but because oil is tied to something much harder to fake: physical reality. Oil does not run on hope. It does not move because a television anchor sounds confident or because a few major stocks drag an index upward. Oil responds to shipping, refinery demand, transport flows, geopolitical stress, supply discipline, production risk, sanctions, military tension, and the real cost of keeping the modern world alive. That is why when oil starts sending a different signal than Wall Street, intelligent investors should stop and listen carefully. Wall Street often lives in a world of expectations. It prices in rate cuts, liquidity hopes, soft landing dreams, AI excitement, future earnings, and the belief that central banks can manage every crisis with the right language and enough patience. Oil lives in a harsher world. Oil asks whether tankers can move safely. Oil asks whether producers can keep supply stable. Oil asks whether conflict is threatening a shipping route, whether refineries are tightening the system, whether global demand is stronger than expected, and whether the world is becoming more expensive to operate. In other words, Wall Street can become comfortable inside a story, but oil keeps measuring stress in the real economy, and that is why oil can sometimes see trouble long before the stock market is ready to admit that trouble exists. This matters enormously in 2026 because the world economy is no longer dealing with one simple risk at a time. We are dealing with stacked pressures: rising debt, geopolitical fragmentation, energy insecurity, fragile trade routes, supply chain rerouting, strategic rivalry, inflation fatigue, currency strain, and an increasingly unstable balance between financial assets and real-world fundamentals. The biggest mistake people make is thinking that economic crises always arrive in an obvious form. They do not. Sometimes they begin as contradictions. Stocks say one thing, commodities say another. Bond markets show stress while equity markets celebrate. Central banks claim progress while households still feel squeezed. And oil once again becomes one of the clearest markets showing whether the real economy is actually healing or whether the system is simply being covered by temporary optimism. That is the heart of this title. What oil sees that Wall Street is missing? Oil may be seeing that inflation is not truly defeated. Oil may be seeing that the cost structure of the world is rising again. Oil may be seeing that geopolitical calm is fragile and temporary. Oil may be seeing that shipping security, energy investment, and industrial resilience are much weaker than financial markets assume. And if that is true, then Wall Street's optimism may not be a sign of strength at all. It may be a sign of delay, a sign that the paper economy is still ignoring the message being sent by the physical economy. Think about what oil actually touches. It is in freight, aviation, farming, trucking, manufacturing, chemicals, defense, plastics, logistics, consumer distribution, industrial heat, and the movement of almost everything that supports everyday life. So when oil remains firm or starts climbing while markets talk as if inflation is old news, that is not a minor technical disagreement between traders. That is a warning that the real economy may still be under pressure, because higher oil prices do not stay in one corner of the market. They spread. They hit transport. They hit food. They hit shipping. They hit company margins. They hit airline costs. They hit consumer budgets. They hit expectations. And eventually they hit central banks, because once energy starts feeding broader inflation again, the dream of easy rate cuts and painless recovery begins to crack. This is where the situation becomes even more dangerous for Wall Street. Equity markets often perform best when they believe monetary policy will turn supportive, inflation will fade, and growth will remain good enough to protect earnings. But what happens if oil is telling us the opposite? What happens if energy costs begin rebuilding inflation pressure just as markets are pricing relief? What happens if the physical cost of running the economy starts rising again while asset prices are still floating on confidence? Then the adjustment can become violent, because markets do not just reprice data, they reprice illusions. And when a market realizes it was looking in the wrong direction, it does not move politely. It snaps. There is also a deeper global money system story here, and serious viewers should understand this clearly. Oil is not just a commodity. Oil is linked to the architecture of power itself. It is tied to the dollar system, global trade settlement, strategic reserves, sovereign leverage, military security, and the financial relationships that hold the international order together. When oil becomes unstable, it does not remain an isolated energy story. It can become a currency story, a bond story, an inflation story, a geopolitical story, a confidence story. If nations face higher energy costs while also carrying record debt and slowing growth, then central banks face a brutal choice: tighten too much, and they risk deeper economic pain; ease too soon, and they risk a renewed inflation wave. This is exactly the kind of pressure that turns a fragile recovery into the beginning of a new crisis phase. And that is why oil may be seeing something Wall Street is still refusing to price honestly: the possibility that the next chapter of 2026 will not be defined by stability, but by collision. A collision between high asset prices and weak real-world foundations. A collision between debt-heavy systems and stubborn inflation. A collision between financial hope and physical scarcity. A collision between central bank credibility and the political pain of rising costs. In that world, oil becomes more than a market. It becomes a warning light for the entire economic machine. Now bring this back to the average American viewer, because this is not just about charts and traders in suits. If oil is right and Wall Street is wrong, families feel it, drivers feel it, small businesses feel it, consumers feel it at the gas station, in groceries and airline tickets and delivery costs, and in the general sense that daily life keeps getting more expensive even when experts say inflation is under control. That is when public trust begins to weaken. That is when people stop believing the recovery story. That is when the gap between official language and lived reality starts becoming politically and economically explosive. And history shows that once that gap grows too wide, markets eventually have no choice but to reconnect with reality. So when we say oil sees something Wall Street is missing, we are really saying something much larger. We are saying that one market tied to the physical world may be exposing weakness that the financial world still wants to ignore. We are saying that the next shock may not come from where the crowd is looking. We are saying that inflation could be more persistent, economic fragility more structural, and the global money system more stressed than mainstream narratives currently admit. And above all, we are saying that in a world built on leverage, debt, energy dependence, and geopolitical tension, the smartest signal is often not the loudest one. It is the one most people are too distracted to watch. That is why serious analysis matters, because anyone can repeat headlines, anyone can react to stock moves, but real economic understanding begins when you study the signals underneath the headlines, the structural forces underneath the optimism, and the market relationships that quietly reveal where pressure is building next. Oil is one of those signals. It has the power to expose inflation before economists fully admit it, expose fragility before policymakers fully understand it, and expose economic truth before Wall Street is emotionally ready to accept it. What if the market that sees the real economy first is the one most investors watch last? What if the earliest warning of the next inflation shock, the next recession scare, or the next global crisis does not come from Wall Street at all, but from oil? That is the first truth serious students of economic and financial history must understand. Oil has repeatedly acted as one of the earliest detectors of real stress inside the global system. Long before polished headlines catch up, long before equity analysts revise their forecasts, and long before central bankers change their tone, oil often begins to react. It reacts not to comfort, not to sentiment, and not to the hope that monetary policy will save the day, but to the physical condition of the world economy itself. Oil feels the pressure of industry, shipping, transportation, refinery demand, military risk, trade disruption, and supply weakness in real time. That is why its message can be so important. It is not simply another market fluctuation. It is often a direct signal from the foundations of modern economic life. Throughout modern history, the most powerful economic systems have depended on energy the same way the human body depends on blood flow. Factories cannot run without it. Goods cannot move without it. Planes do not fly, trucks do not deliver, ports do not operate, and supply chains do not hold together without it. This gives oil a unique status in financial history. Stocks can move higher because investors are optimistic. Bonds can rally because markets expect policy easing. Currencies can strengthen because of capital flows and temporary confidence. But oil is forced to confront reality at a much lower level. It asks harder questions. Is industrial demand weakening? Are tankers moving normally? Are refiners under pressure? Is a war zone threatening a transport route? Is underinvestment limiting future supply? Is the economy truly healthy? Or is the financial system simply celebrating a story that has not yet met reality? These are questions that make oil far more than a commodity. They make it a warning system. That is why, in many major turning points, oil has moved before the wider financial world fully understood what was coming. When inflationary pressures begin building, oil often feels it early because rising energy costs move through the entire economic machine. When geopolitical risk starts threatening trade flows, oil often responds before equity markets stop pretending the danger is temporary. When global growth weakens, oil demand starts softening in ways that reveal damage beneath the surface, even when headlines still sound calm. This is one of the great lessons of economic history. The stock market often reflects what investors hope will happen, but oil often reflects what is already happening, and that difference matters enormously in periods of instability. Wall Street, by design, is forward-looking, but it is also deeply emotional. It can become excited by liquidity, by central bank signals, by technological enthusiasm, by strong earnings from a few dominant companies, or by the belief that the worst-case scenario has been avoided. Oil is different. Oil is tied to movement, production, conflict, infrastructure, and the raw cost of keeping the world running. That is why it can expose a dangerous mismatch between paper optimism and physical stress. A stock index may look strong because capital is flowing into a narrow group of large companies, yet oil may still be warning that transport costs are rising, that supply remains vulnerable, or that inflation risk is not truly dead. In that kind of moment, oil is not contradicting the economy, it is revealing the deeper layer of it. This is also why serious analysts treat oil with such respect during fragile periods. Oil does not need a speech from a policymaker to tell it that the system is under pressure. It sees pressure in freight movement, in refinery margins, in shipping insurance, in military risk, in production discipline, and in the nervous behavior of countries trying to secure supply. It sees when the global machine is becoming harder and more expensive to operate, and once that happens, the broader economy usually feels it soon after. Households feel it at the pump. Businesses feel it in transport and input costs. Governments feel it in inflation data and public frustration. Central banks feel it in the impossible choice between supporting growth and restraining prices. Investors feel it when the comforting narrative begins to crack. This is what makes oil such a powerful historical indicator of real economic stress. It does not merely react to the economy after the damage is obvious. It often starts whispering before the crisis becomes visible, before the fear becomes official, and before the financial crowd is emotionally ready to listen. What if the biggest danger in financial markets is not panic, but misplaced confidence? What if Wall Street is not missing the warning because the signal is weak, but because the story it wants to believe feels far more comfortable? This is where the divide becomes so important. Wall Street often prices hope, while oil prices reality. And across economic and financial history, that gap has appeared again and again at some of the most dangerous turning points. Equity markets are capable of rising on expectations, on policy optimism, on liquidity, on momentum, and on the belief that central banks will step in before anything truly breaks. Oil does not have that luxury. Oil trades much closer to the physical world. It reacts to supply constraints, transport demand, refinery conditions, geopolitical instability, shipping risk, production discipline, and the raw cost of keeping industrial civilization functioning. That is why oil can look harsh, stubborn, and uncomfortable when financial markets still look calm. It is not because oil is irrational. It is because oil is often measuring the world as it is, while Wall Street is still trading the world as it hopes it will be. This difference is not a small technical detail. It is one of the most revealing contrasts in economic history. Stock markets are deeply influenced by expectation. If investors believe interest rates may fall, stocks can rise well before the real economy improves. If large companies continue reporting decent earnings, indexes can remain strong even while pressure builds underneath the surface. If policymakers sound reassuring, the market can reward confidence itself. In that sense, Wall Street often behaves like a mechanism for projecting future comfort into present prices. But oil is tethered to the hard machinery of the real economy. It asks whether factories are operating, whether ships are moving efficiently, whether airlines, trucks, and industrial supply chains are facing higher input costs, whether producers are investing enough, and whether geopolitical events are putting real barrels at risk. It is far less impressed by narratives and far less willing to ignore physical strain. That is why history repeatedly shows moments when equity markets seemed relaxed, even bullish, while oil was already flashing concern. The stock market may interpret easing inflation data as a reason to celebrate, while oil remains elevated because supply is tight and energy security is deteriorating. Wall Street may become excited about a soft landing, while oil starts reflecting the uncomfortable truth that trade routes are exposed, that production discipline is holding supply back, or that global demand is stronger than expected in precisely the areas that feed inflation. The result is a dangerous disconnect. On one side, you have financial optimism supported by sentiment, policy assumptions, and concentrated flows into risk assets. On the other, you have oil quietly reminding everyone that the physical economy still runs on energy, and that energy does not care about investor mood. What makes this even more important is that hope can survive longer on Wall Street than many people think. Markets can continue rising even when the underlying structure is becoming weaker, because confidence itself can become self-reinforcing for a time. Analysts upgrade targets, television commentators speak with increasing certainty, and price action begins to create its own emotional logic. But oil tends to resist that kind of illusion. If the real-world cost of movement, production, and supply security is rising, oil reflects that pressure whether investors like it or not. If a shipping route becomes vulnerable, if a producing region becomes unstable, if underinvestment limits spare capacity, or if sanctions and strategic rivalry threaten the flow of energy, oil begins to respond. It does not wait for consensus. It does not wait for a polished narrative. It responds to friction in the real system. And that is where the deeper warning lies. When Wall Street prices hope and oil prices reality, the gap between the two can tell us something profound about the state of the world economy. It can tell us that markets are becoming too dependent on policy rescue. It can tell us that investors are overestimating stability and underestimating structural fragility. It can tell us that inflation risks are being treated as yesterday's problem, even while the energy market is hinting that the cost base of the global economy remains under pressure. It can tell us that the financial system is floating on confidence, while the industrial system is becoming harder and more expensive to maintain. This is why serious market analysis must go beyond stock indexes and headline optimism, because the most dangerous moments are often not the ones filled with obvious fear. They are the ones filled with selective confidence, where one market is celebrating and another is warning. And in those moments, oil often becomes the more honest messenger. It reminds us that economies are not built on sentiment alone. They are built on energy, logistics, production, and physical continuity. Wall Street can trade the promise of tomorrow, but oil keeps asking whether the world can still afford the cost of today. What if the next inflation shock does not begin with a central bank statement, a shocking jobs report, or a collapse on Wall Street, but with oil quietly refusing to behave the way policymakers expected? What if the one market that looks simplest on the surface is actually exposing the deepest weakness underneath the entire global economy? This is why the history of oil matters so much in economic and financial analysis, because rising oil prices have repeatedly done something few other markets can do. They have exposed hidden inflation, uncovered structural weakness, and revealed how fragile the economic system really is beneath the language of confidence. Again and again, oil has shown that an economy can look stable on paper while still carrying deep internal stress. That is because oil does not merely reflect energy demand, it reflects the operating cost of the modern world. When oil rises sharply, or when it refuses to fall even as recession fears spread, it sends a message that should never be dismissed lightly. It suggests that the cost structure of the system is changing. It suggests that inflation pressure may still be alive even when official narratives sound reassuring. It suggests that the world economy is more dependent, more exposed, and more fragile than financial markets may be willing to admit. This is one of the most important lessons in finance history. Inflation is not always obvious at first. It often hides in production chains, transport costs, logistics, manufacturing inputs, freight charges, and industrial margins before it fully appears in the numbers that households and investors are trained to watch. Oil sits at the center of that process. It is not a side issue. It is one of the main transmission mechanisms through which cost pressure moves from the physical economy into the financial one. That is why oil has so often acted like a truth signal during periods of false comfort. A stock market can rise because investors believe policy support is coming. Bond markets can stabilize because traders expect inflation to cool. Governments can reassure the public with optimistic language. But if oil is climbing or staying stubbornly elevated, it may be warning that the underlying system is still under strain. It may be telling us that transport is getting more expensive, that supply remains tight, that geopolitical risks are not contained, or that global demand is stronger and more inflationary than expected. In that sense, oil often exposes the hidden contradiction between what policymakers are saying and what the physical economy is actually experiencing. And once oil begins transmitting that pressure, the effect rarely stays isolated. That is the danger. Higher oil prices do not remain trapped inside commodity charts. They spread outward through nearly every layer of economic life. They affect trucking, aviation, shipping, food distribution, industrial production, plastics, chemicals, agriculture, and retail pricing. They squeeze company margins even when revenues look healthy. They weaken consumer purchasing power even before official inflation data becomes alarming again. They create stress for governments because households do not experience inflation as an abstract number. They experience it through the daily cost of living. This is where economic fragility becomes visible. A system that looked resilient when energy was cheap begins showing cracks once the cost of movement and production starts rising again. This is also why oil has historically exposed systemic weakness so effectively. It forces a confrontation between financial optimism and physical limits. An economy may appear strong because asset prices are rising, credit markets are functioning, and employment data looks acceptable. But if energy costs begin climbing into that environment, they test how real that strength actually is. Can businesses absorb the higher input costs without cutting margins or raising prices? Can consumers continue spending when transportation and essentials become more expensive? Can central banks remain confident if oil starts rebuilding inflation pressure at precisely the moment markets are demanding easier policy? Those are not small questions. Those are the pressure points that reveal whether stability is genuine or merely temporary. And this is where the phrase systemic fragility becomes so important. Fragility means the system performs well only under favorable conditions. Fragility means confidence depends on cheap energy, smooth trade, stable shipping routes, and predictable supply. Fragility means that once oil rises, the system begins losing its balance. Debt-heavy economies feel it faster. Import-dependent nations feel it harder. Central banks face more painful trade-offs. Financial markets begin to realize that what seemed like recovery may actually have been a pause between shocks. Oil has a unique ability to reveal that truth because it touches the real machinery of economic life more directly than almost any other market. So when oil rises and refuses to calm down, serious analysts do not just ask what is happening in energy. They ask what the energy market is revealing about inflation, about policy limits, about consumer vulnerability, about industrial pressure, and about the strength of the broader economic order. Because throughout financial history, oil has not simply been a commodity that reacts to crises. It has often been the force that exposes them before the wider system is ready to admit how serious they are. What if oil is not just warning us about energy, but about the future of money itself? What if the next great stress in the global economy does not begin as a simple commodity story, but as a deeper fracture inside the very system that governs trade, debt, power, and financial confidence? This is where the fourth key point becomes especially powerful, because oil is not merely an industrial fuel or a market input. Across modern economic and financial history, oil has been deeply tied to the structure of the global money system itself. It has influenced the strength of currencies, the balance of power between nations, the role of the dollar in world trade, the behavior of central banks, the pricing of risk, and the financial relationships that hold the international order together. That is why when oil sends a warning, the message often reaches far beyond inflation or energy supply. It can be signaling stress inside the monetary architecture of the world. To understand this properly, serious viewers have to see oil not just as a barrel of fuel, but as a strategic foundation of global finance. Oil is purchased, settled, transported, insured, and financed through systems that are deeply connected to sovereign power and reserve currency dominance. That means oil is never only about demand and supply. It is also about who controls trade routes, who holds pricing power, which currency dominates settlement, which nations can absorb energy shocks, and which financial systems are strong enough to survive them. In that sense, oil has always had a dual identity. On one level, it is physical energy. On another, it is a mirror reflecting the deeper balance of monetary power in the world economy. And when that mirror begins showing distortion, wise analysts pay attention. This is where the relationship between oil and the dollar becomes especially important. Because when oil markets become volatile, questions emerge not only about inflation and growth, but also about settlement power, reserve demand, external balances, and the durability of the existing monetary order. If more nations begin seeking alternatives, hedges, or strategic realignments in response to repeated energy shocks, then oil can become part of a larger story about the future of global money. Not an overnight collapse, not a dramatic slogan, but a slow and meaningful pressure on the assumptions that have defined world finance for decades. And that is why oil deserves to be treated as a monetary signal as much as an energy signal. It tells us when the system is becoming more expensive to defend, more difficult to stabilize, and more vulnerable to forces that cannot be solved by financial optimism alone. So when oil sends a warning, serious analysts do not hear only a message about fuel. They hear a message about debt sustainability, currency pressure, policy limits, inflation persistence, sovereign vulnerability, and the hidden strain inside the global money system. They understand that oil has the power to reveal not just how economies run, but how the financial order survives. And in times of rising uncertainty, that makes oil one of the most important truth tellers in all of economic history. Thank you for watching. I am John A.G., and this is The Wealth Reactor. If you want premium, serious, and deeply researched analysis on oil, inflation, recession risk, financial markets, precious metals, Bitcoin, and the global money system as we move deeper into the high-risk world of 2026, then subscribe to the channel and join my WhatsApp group for real updates. Because here, we do not follow the crowd. We follow the signal. And in times like these, seeing what others miss is not just an advantage. It is everything.